Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Yep, glad to have you with us as we talk about financial matters. We are recording this on March 3rd.
Yes.
So lots moving right now. If things have changed between the time of recording and the time you listen.
That's almost a guarantee.
Yeah, absolutely.
It's, wow. I tell you, over the weekend, right, obviously we move on Iran. Kind of saw that coming, the buildup in forces, the negotiations.
Yeah, you think?
You kind of saw that coming. You didn't know when it was going to happen, but you kind of saw it. The prediction markets, which I think are actually just ripe for fraud and theft, they're actually really pretty good at predicting these sort of things. When people put money on their beliefs, they have a tendency
Well, particularly when somebody has a little bit of inside information on it.
That's true. That's true. I didn't think about it like that.
So
yeah.
There's someone with access to the situation room or wherever these decisions are made can suddenly. But that's another story.
But the prediction markets were pointing this direction.
That's right.
And then Monday, it's just like the markets were
like finished up again.
Yeah, it's just like meh.
Well, it felt like they almost waited till the markets closed on Friday. Right? There was some. And then
Tuesday morning, we're off, 1,100, 1,200 points on the Dow?
And as the time I look at this, we're off 600. So.
Yeah, it's crazy. It's but we'll be there for weeks.
But the couple of things. One is the number, as the markets get higher, the numerical value is much larger. So 1,000 points in the market today is a little over 1%, 2%, let's go. 1,000 points 20 years ago.
20 years ago was
10%.
Much more significant, yes.
Yeah. So I think that's
how numbers and percentages work.
I just recall, Pat, when we were, this was back, what was the Russian long-term?
Capital.
What was it? Yeah, LT, whatever.
Yeah, long-term capital.
This was in 1997 or 8. I'm sorry. Yeah, 1997 or 8. And we had some conference down in San Diego, some sort of a financial conference.
That we were attending?
We were attending, and the Dow was off 500 points that day. That was a time when 500 points was a big deal because the Dow hadn't even hit 10,000 yet. 500, a big day. And the planned outing, it was some sort of like a networking thing, was at the Del Mar racetrack. And I remember the two of us talked. We said, we cannot be at the racetrack the afternoon of the Dow falling
just a bad
5% or whatever. Yeah, just didn't feel right. Like, how could we be doing something like this?
Did we go?
Up? No, we didn't go.
Oh.
We did not go. You have no recollection of it, apparently.
None whatsoever.
I don't know why I remember that.
I've never been to the Del Mar racetrack.
I never have either. I've never been to a racetrack, for that matter.
Really?
I've never been to a horse race. A lot of dog races.
I'm
joking. I've not been to a dog race.
I went to the Kentucky Derby.
I remember you. And
it's one and done. It was like 2 trips in one, my first and my last.
Sometimes those big crowds, like the Super Bowl or the Olympics we just had, LA Olympics are coming up, a couple of years. Like there are so many people that go to this. I tend to avoid all those major things because I don't like huge crowds.
All right, so back to the markets. We lost way already. So back to the markets. So the history tells us that after this sort of thing, like as long as it's not prolonged, the markets recover relatively quickly, 75% of the time.
Well, it's because what drives the price of something? It's the future cash flow that's going to produce, right? So if it's a company, even if they're not profitable right now, if they're growing like crazy and you believe there's going to be profits in the future, you can develop a model that says, okay, these are going to be the cash flows in the future. You can discount that based upon where things should be priced today. The more uncertainty in that future cash flow, the less an investor's willing to pay. So really what happens in times like this, it's the uncertainty. For the most part, people don't believe that Iran's going to win this battle, right?
That's correct. The question is if China comes in, and that doesn't look likely, and Russia doesn't have the means to. And those are the only other two powers that would actually appear that would support Iran.
Yeah, I think what most people are looking at is how long is this going to take? What's going to happen to the price of oil?
And the Hormuz Strait, how long will that
all
be?
That stuff. Yeah. And that's, I think, a lot of the uncertainty right now.
Which is actually surprising that that they haven't come out yet and said, don't worry about the oil. We're going to get it all from Venezuela. I've been waiting for the administration to say that. I've been waiting for that, but it hasn't happened.
Whether you think this was a wise move or not move, it's irrelevant from an investor standpoint. This is where we are.
That's right.
And we're not going to make comment on how we personally believe about things. It's more of a...
Like this is shocks like this have happened before. So...
Yes, again and again and again.
And again, yeah.
Yeah. I mean, I still remember when the American hostages in Iran, 1979. Long time ago. It didn't feel that long ago.
Yeah.
Same regime.
Yeah. It's wild.
But here we are.
There we go.
Life continues on.
Yeah, and later on the show, Scott, if we have time, I'd like to talk about what is lurking beneath those calm stock indexes. And we talked about this a couple of weeks ago about the dispersion in the marketplace.
Yeah. It's really interesting.
It's really interesting. Which is the argument for a diversified portfolio. It is the argument. So
we got that to look forward to.
Oh, my gosh. If that wasn't a tease, I don't know what is.
Maybe they're going to want to hear us more about the racetracks that we did not go to. All right. If you like to be a caller on our program.
The conferences back in the day. I'm so glad I don't have to go to any of those.
You never went to them anyway. Pat was classic because if there's a conference, and we would speak at conferences quite a bit. So there'd be a conference, and let's say the conference started at Tuesday at 5 p.m. and finished Thursday at noon. Pat would probably show up maybe an hour before we speak, 2 hours before we speak.
If I did it
have
right.
the thing, and you had good intentions to stay through the whole conference. So he'd have his flight booked like that Thursday afternoon, but invariably you would leave as soon as you could.
That's right. I called it businessman's jail.
You would leave as soon as you could.
Oh, I hated those. People just sitting around talking about themselves. I just hated it.
I never forget. I was young in the business, and Franklin Templeton had this due diligence conference, they would call them.
With in air quotes?
They were kind of. So this was back in the 90s. And they were based in Bahamas, Templeton was. So they had this thing in the Bahamas. I thought, I'm a young person, a free opportunity to go to Bahamas. Why not? And so, honey, let's go to this due diligence.
You brought your wife.
That's where the story's going.
Holy smokes, what's wrong with you?
I was young. I was inexperienced. So we're
not that. Let's just clarify. Not so you could get out there and be like wild in the world. You don't bring your wife because you don't want to have to subject herself to the people in our industry.
That's my point. Okay, so here's the story. So we're having dinner that night. It's a round table with mostly financial people and a handful, not very many spouses, but my wife's sitting there. And there was one guy, he would not shut up about his house, how big his house was, his wine collection, and his car or cars, whatever it was. He was just so full of himself. And they seemed like the kind of guy that gives the industry a bad reputation, because I think he was in the industry more because he loved big houses, wine, and Ferraris than he loved serving clients. And I remember telling my wife at the end of the night, I'm sorry, honey, I will never take you on one of these again.
And did you keep the promise?
I did. She never went to anything again. And people would say, how come I never meet your wife? Thinking I'm not bringing her around anywhere.
Yes.
By the way, I haven't gone to one of those conferences since the 90s. Things have changed a bit in the industry, and we've changed quite a bit. So, all
right, let's go to the calls.
Yeah.
If they wanted to join the show, how would they join the show?
Email us, questions@moneymatters.com. Questions@moneymatters.com. All right, let's start off here talking with Mike. Mike, you're with Allworth's Money Matters.
How y'all doing, Scott and Pat?
We're doing good, Mike. Glad you were joining
amazing.
us.
I've really appreciated your podcast. I've been listening for a couple years and have gone back and listened to a lot of them, and I think I've gained just enough knowledge to be dangerous.
Okay, well, good.
So hopefully
I doubt it, but anyway.
So I have heard I've heard that sometimes, I believe it was a previous show, that people in their mid-50s sometimes maybe should review and make sure that maxing out their 401k is actually a positive thing to do as compared to maybe in putting money into a brokerage account. Yep. And so I wanted to ask you in my situation if that's something that I should be looking at.
Yeah, and I would say kind of as a rule of thumb, for those that have ample retirement savings, maybe even, I shouldn't say overfunded, but have been big savers their entire career and have large balances in their 401k and plenty of retirement assets, they're more likely to say now's maybe a time to reduce our 401k deposits, because odds are their income in retirement is going to be as large, or if not higher, than it was during their working years. But for the vast majority of Americans, they're in the 50s. That's your big time to save. Kids are gone. Like now are hunkering down. Maybe a spouse worked part-time or didn't work during the kids' years. Now both spouses are working. It's a huge saving opportunity. And for most Americans, their income is going to be lower. Taxable income is going to be lower in retirement than it was in their 50s. So anyway, give us that's our opinion on things. Give us your situation.
Okay. So I'm 57. My wife is 55. And we've got about $700,000 in 401k and IRAs. We've got a Roth IRA of $40,000. We've got a high yield savings account of $90,000, and then we've got a brokerage at $850,000. And we're actually considered high income earners right now.
How is that brokerage account invested?
So the brokerage is a 60% 500 index, 15% total international index, and 25 bond index.
Right. And how about the 401k
and hold on, are those just 3 funds in that brokerage account?
Correct. They're all index funds with Fidelity. Yeah.
All right. And tell us about the IRAs and 401ks. How are they allocated?
The IRA is a growth. I believe it's a growth, and the 401k is a target date fund. So I believe we've got 2035, I believe is what it's in.
Okay. Well, we got some help for you here.
Yeah, I know.
Good.
Yeah. Target dates are great for $7,000 accounts, maybe even up to $50,000 accounts. But every target date fund is managed differently.
And they're actually they're driven by calendars and not by economic environment, which means that based upon your age, they actually allocate the stock to bonds. So sometimes you actually find yourself actually selling off stock in a down market, which doesn't make any sense. Couple other questions for you. Will you be receiving, or will your spouse be receiving, a pension?
No pension.
And what's your income right now? Salary, total compensation?
So last year was $740,000.
What's it been the last 5 years average? Is this was that an aberration, or have you guys been in?
It's pretty consistent. The year before was around 700, and before that it was in the 400s, and so it's definitely increased over the last few years. And I don't expect it to decrease very much.
Are you self-employed?
No, we work for a company.
Okay.
Corporate.
And what state do you reside?
Mississippi.
And do you have any debt?
I have a tractor that I 0% interest, so I don't know if I consider that. And then other than that, only my house.
And how much do you owe in the house?
We owe $145,000 on the house. It's on a 15-year, 2.5 mortgage, and I've got 8 years remaining on that. I've actually been paying a little more on that. I'm kind of one of these people that don't like to have a payment and don't like to have debt, so. But I know that's probably not the wisest financial decision necessarily.
How much money did you make when you were 50? What was the household income when you were 50?
Let's see. Probably around 200.
Okay. Because you scared us. We're looking like, wow, why has he got so little money?
I mean, if you were a physician who's making $740 and 20 years ago you were making $940, we'd be like, where'd all the money went?
And
a lot of it has been maxing out over the last few years.
Okay,
and so that's where a lot of it came from.
Well, you
definitely want late start.
You definitely want to continue to fund that 401k and the IRAs, non-deductible IRAs.
I would fund that 401k pre-tax at this rate.
And actually,
I was wondering about the 8,000. Isn't there something about a Roth that you have to have a 8,000 now in a Roth 401k?
Oh, there's that limit on whatever that is.
Yeah, but
your administrator will tell you.
Yeah, you want to put as much in as they will possibly let you.
Yeah, there was a change beginning of this year.
Yeah,
was it over age 50?
Yes.
Yeah.
So you want to max that out, and then your asset location is kind of messed up.
Okay.
And the reason being is you've got bond in your 401ks and IRAs, and you have quite a bit of bond in your brokerage account. Let me think about this. He's gonna.
What's retirement? What's the goal here?
Well, I think it's kind of. I mean, I kind of am thinking like about 10 years or a little bit less. But I think it's kind of whenever we choose to.
Well, not now. You can't choose you can't retire today.
No, no, definitely not.
See, here's the problem in your is we need to determine how much income you're going to need in retirement, because you at $2 million now. Let's just say we get it to $4 million before you retire, right? Let's just say and your income is just $700,000 a year. If we get it to $4 million,
less than $2 million in savings.
Understand that, but let's say we get it to $4 million by the time you retire, in 7-8 years, we get it to $4 million. Let's just say we start taking a 6% distribution,
which would be high.
That's $240,000 a year. So we went from an income of, you're putting money into Social Security, but you went from an income of around $650 that you were living on,
maybe higher.
Yeah,
pre-tax
to much lower, to 240 plus Social Security. You've got a substantial difference in your standard of living.
What did your brokerage account look like 5 years ago?
I didn't have one, so this is something that's recent.
Okay, we're feeling better.
We were very blessed with some generous family members that gave us some money, and so. It's been sitting in high yield savings and
So here's what the problem is. This $2 million looks like a lot of money. In anyone's world, they'd say, "Oh, he's got $2 million. This Mike, man, what a hitter!"
It's more like 1.6.
Okay.
Well, I do also have another home that we own outright. That's worth about $270,000.
Is that rented?
And I have a family member that is kind of renting it. It's below market value, but it's more of just kind of a helping them out kind of a thing.
You need a financial plan. That's it's flat out. And the reason is that based upon your income and compared to your savings,
a major lifestyle change when you quit working.
And that's what I was wondering, because we actually don't have a very high lifestyle now.
Yeah, you do. That money goes somewhere.
We're putting it into savings and into investing, but we're not spending it.
No, I don't think so. It doesn't. The numbers don't tell us that.
If you said you were making as a family $150,000, and this is just kind of suddenly things have changed, that looks a little different.
But from the numbers that you shared, what your income is versus the savings, and look, we recognize most of it has taken place over the last 5 years, but the increase in the income, your savings levels would be much higher.
That's a bigger concern for how things are invested.
Oh, that's right.
That's the big concern that we have.
Gotcha. So right now, you would suggest that I just continue maxing out?
No. I would suggest you and your wife get a financial plan and have the projections run. Like, here's what things are going to look like 10 years from now. And so you get some clarity on what you need to do between now and 10 years to make sure you've got the financial security to maintain your lifestyle. Then you work backwards and say, okay, in order for us to accomplish that, how do we need to have things allocated? And we need contingency plans. What happens if we have a health issue and we can't continue to work another 10 years?
But Mike, what my guess is, and we see this a lot, is all of a sudden your income spikes. You had lifestyle creep, right? You might have gone. You might have gone and got a new boat,
new tractor.
No
barbecue.
No, well, maybe a barbecue, but not a high end one.
No, I remember. The reason I bring barbecue is I had these clients one day, and I said, people that have lifestyle creep oftentimes will be comfortable going out and spending $15,000.
There's a $300 barbecue at Home Depot, and then there's the $30,000 backyard barbecue kitchen that people build.
That's right,
or $60,000, whatever the number. So
what?
We did spend a few things. We added onto the home and a couple of things like that.
We know.
did do that.
We know. You what the problem is that you've had some
it's
lifestyle
a fixable problem,
but it's 100%.
You've got great income,
and
I don't think you're spending all your income either.
That's right. But a financial plan will actually say, okay, this is how much we're going to save. This is the earliest we can retire. This is what our income will look like in retirement, and this is the latest we should retire, and this is what our income will look like.
And then, all right, here's how much we should be saving into the 401k, to the Roth, to the brokerage account. Here's how we should think about allocating our dollars.
And then from there goes asset location, which is where you're a little bit messed up, which is you should have nothing but equities in your brokerage account. You should have all your bond in your IRAs and 401ks.
Gotcha. Okay.
Because of how the taxes currently, under current tax law, treat those different types of assets. And that's asset location. If you were my brother-in-law, heck, I did this with my brother-in-law. I paid for a financial plan for him. I knew the owner, so I was able to get a discount on it. But I would offer that to you. I would offer that to you that if you call Allworth, we will give you a free financial plan and walk you through it.
What?
Wow, that's amazing. That's awesome. You're really going to do that, huh?
Yeah.
Okay.
Am I not empowered?
It's not an oven mitt or something like the banks would give out.
I'm empowered to do that.
All right.
I think I'm empowered to do that. Yes, I'm empowered to do that.
Thanks for calling, Mike.
That would be very, very helpful, and I would certainly appreciate it.
Okay,
right.
That's what you need.
What a guy, Pat.
What? I'm not doing
What, are you
it.
drinking this morning or what?
No, but I'm not doing the financial plan. It's easy to give away someone else's time.
You mentioned your brother-in-law and a financial plan. My brother-in-law, we did a financial plan for him.
I remember this.
And then, 4 weeks later, he calls and says, "Hey, can I get your opinion on?" I said, "Sure." And he says, "Yeah, but this other financial advisor recommended this sort of allocation. What do you think of this allocation?" And I said, "Well, didn't one of my advisors do a plan, an allocation for you?" "Yeah, but I thought I'd have someone else look at it too. So I kind of want your opinion on this other person."
It's just like
I said, "Well, we gave you my best advice, so I don't know what there's to discuss."
Do you want me to change my advice?
It was really bizarre.
Yeah.
But anyway. All right.
I'm sorry. Fortunately, he probably doesn't listen to this show.
I hope. Well, it was a little insulting, frankly. I was a little miffed by it. Well, yeah. Wouldn't you
really? You got mad at a family member. That's strange.
It's really odd.
It's super strange.
Who knew? All right, let's talk here with Robert. Robert, you're with Allworth's Money Matters.
Yeah. Hi. I have a question regarding retiring here in a few months at the age of 55 and taking care of utilizing this window to do Roth conversions.
Okay.
All right. Good. Tell us about your situation.
So account-wise, we've got, I've got $2 million in 401k, $23,000 in an IRA. My wife has $300,000 in an IRA. Brokerage accounts, we've got $315 in brokerage, $115 in a managed brokerage account, $50 in what I call a fun account, and $125 in T-bills. We've got it's a long list. I'm sorry.
That's all right.
$120 in an HSA, $17 in the bank, and $20,000 in a 529 plan.
Who's the 529 plan for?
Grandson.
And how old is your spouse?
51.
How old are you?
And 54.
And will one of you or both of you be receiving a pension?
No, neither.
What's your family income right now?
180.
And what do you feel you need in retirement?
Well, currently, so our home's paid off. Our expenses last year was $80,000.
And how did you determine those
includes
expenses?
Travel.
How did you determine?
Going through checkbooks.
Okay. All right.
Doing the math.
Well, sometimes
so oftentimes when we ask people, what are your expenses, what they'll actually do is actually
make a little list
of their bills, but really what we're interested in is how much are you actually living on, which includes all the miscellaneous stuff that somehow doesn't seem to get counted.
Gotcha.
So 80,000. And why do you want to retire so early, or your spouse? How do you see your life?
So it's since COVID, I've had several coworkers actually pass away, and I just feel like if I can do this, I've beat the game. Frankly, honestly, that's why I've been with my employer for quite a long time, and I think
if your expenses are $80,000 a year, you can retire. I mean, there's always a choice. I've had this discussion with so many people over the years. Like, look, here's what your financial life will look like post-retirement. And I've had some people say, well, I can't really live on that, so I can't retire. I've had other people say, I want to retire so badly. That sounds fantastic.
So is there a happy medium for you? Have you considered that? Would your job allow you?
Well, from a financial standpoint, let's just cover this real quick. So
he can do it.
If you think a 4% distribution, it's just a basic rule of thumb. There's some flaws in that rule of thumb, but I think it's a pretty good. If you can, the 4% rule says I'm going to take 4% withdraw from my portfolio day one, and then as inflation creeps up, I'm going to bump that up by inflation. What happens in the real world is people tend to adjust given the economic cycle. So during the financial crisis, even people who could afford to live large, most people scaled back because they felt a little funny about spending money when their neighbors were broke. Right. So, I mean, that's just kind of that's a bit of a reality. So if you think about you've got roughly $3 million, a 4% rule, that's $120,000 a year. Even after taxes, you should be fine to have net that $80,000. This is before your Social Security kicks in down the road too.
Mm-hmm.
So I think from a financial standpoint, you can pull it off.
Yes, that's correct. The thing that you actually should consider, though, is is when you retire over the age of 55 is how liquid your 401k is between the ages of 55 and 59 and a half if you do not roll it into an IRA.
Right. I do realize that, and I wouldn't. And it is available to me at 55.
Yeah. And correct. And sometimes people will roll part of it into an IRA and keep part of it there, and that's what we would recommend on $2 million.
I love the concept of doing some Roth conversions between now and the next several years.
Yes. Yeah, especially if you have the income to pay for it. And you're going to be in a relatively low income.
What you got going for you is you've got great kind of tax diversification with all of your different types of accounts. So it gives you some flexibility. You can convert some. You can have income coming from somewhere else.
So here's the thing that in the real world I would look to, which is people don't really want to quit working. They want control of their lives.
I would agree.
For the most part.
I feel like I work from home, and I feel like I'm on house arrest during my work day.
My first job out of college, I worked from home, and it gave me anxiety because I felt like I never could leave work. I would get up in the middle of the night and actually go into the office and work at 3 a.m. It was not healthy for me. Can you work part-time? Could you go back to your employer and say, hey,
or maybe you just need a break and figure out.
Yeah, maybe.
Sure. I don't think I would do that with this employer. I'd probably just pick up, a contract or something like that.
Yeah. You've been good. You've been great savers.
Something like that.
You've been great savers, right? And I believe you when you say you can live on $80,000 a year. And maybe what you do is you retire and in all seriousness, take $80,000 and stick it in your account and say, this is what we're going to spend on. This is what we're going to spend in the next year. And kind of
start doing Roth conversions.
And start doing those Roth conversions.
Does your spouse work outside of the home?
She did, yes, for 15 years. And actually, that was a big part of this. So paid off a ton of debt.
She doesn't anymore?
Sort of propped up the accounts. No longer.
All right. Yeah, you look great. You look great.
Yeah, I love the Roth conversion idea during these years.
Because I'm sorry. So which tax bracket should I sort of fill up?
The 12%.
Another question that
I would do the 12%.
Okay.
Because you've got very little in taxable income. I know your brokerage are going to spin it off a little bit. Hopefully it's invested in such a manner that's not, and a little bit of interest. So you have very little of taxable income. And the 12% is, for a married couple, it's about $100,000 after the standard deduction.
Yeah.
Now, I wouldn't be looking at 12%. Would I be looking at like a tax bomb at 75? I mean, I know I'm 20 years out, right? I'm trying to solve a problem 20 years from now.
Yeah, correct. That by doing the Roth conversions, you're actually getting rid of any of the tax bomb. And I wouldn't worry so much about that because if retiring at age 55, you're going to end up taking income from both your IRAs and the other accounts as well.
Okay.
Yeah, I think it's perfect. As long as you're comfortable living on that income, and I can tell you from experience working with hundreds and hundreds of clients that have retired early because they could, many of them go back to work and find it some of the most satisfying work of their lives. Because they're doing it for two reasons. They're doing it for social reasons, right? They want to get out of the house. And they're doing it because they want to. They're much more picky about the jobs they will take after they retire.
But you've saved.
Yeah, great.
You've done a great job savings. You've hit this. If this is what you want to do, you can retire. So maybe just take some time off and spend the next year thinking about what your next 25 years are going to look like, 35 years.
Right. We've been talking about it, and we're calling it recreational employment.
Oh, perfect. What a great name. Yeah. Yeah, and it's good for a couple to stay away from each other sometimes, right? Just not to be together all the time.
Well,
I get it. Oh,
thing.
100%.
Since COVID, this was like early retirement in regards to like how we're going to behave as a couple in the same home.
Oh, I know.
For all this time.
You work full time out of the house?
Yeah.
That's got to be hard.
I didn't realize how social my needs to be social were, how big that was, and not being around people.
I tell you, I joined a gym for the sole reason to go and bother people and talk to them while they're working out. I don't work out myself. I just go and talk to people while they're working out. Yeah.
All right, Robert.
All right. Thank you. Appreciate the call.
Wish you well. You know,
Thank
Pat,
you.
I think a couple things I was thinking after this. One, I had a client who he was in telecommunications, retired, and he was 71, something like that, and worked at Google. And he was like the old sage. He had more fun, and I think he was like 4 days a week or something. But he had a certain wisdom that most of the young people at Google didn't have the age and experience with the same wisdom. Yeah, technology is different today, but
but
people haven't changed.
People haven't changed.
Yeah. And he just loved it. I was thinking then this morning as I went for a run this morning before work.
Wait! You follow that after I say I joined
joking.
a gym? I do.
And
have to go.
But no, I was literally thinking about this morning because I'm 59, right? And been in this industry a long time, and I've helped people retire younger than I am today. And I remember this one couple, they were like late 50s, and they said they were buying a new car because it was the last car they were going to buy. They had remodeled last time they're going to remodel their house. And I remember thinking at the time, you're not that old, it's not like you're 85, but their mindset was, I'm done with work. This is retirement. And I guess this is nearing the end of my life. That's why I had to think this morning because I'm like, and I contrast that with, I'm in this coaching program where the founder is 82 and he says he has more ambition now than he ever has in his life. And he's 12 years into his 25-year plan. And just difference in mindset. And I think as we were talking to Robert, I think your concern is like, if you don't have like a real good plan, you're young. If you don't have a really good plan, these retirement years are not going to be as enjoyable as you might think.
Oh, yes. I mean, yes, you have to have some sort of purpose, right?
Yes.
And the purpose can
be needed.
And
commitments, which seem contrary.
Yeah, but everyone's different. I mean, being needed by one person deeply is probably for a lot of people is more important than being needed by a bunch of people shallow.
For sure.
Right?
You're to your point, Will.
Yeah, everyone's a little different. I just want them to think about it. So
yeah,
or buy a dog.
Buy a dog. My poor neighbors have 5 kids, and
the neighbors that live next to you right now?
Yes, 5 kids.
What are their ages?
The oldest is a freshman in high school, and the youngest is, I don't know, 2nd grade or something like that.
That's a family. I grew up with a family of 5 kids. I ran into a neighbor I grew up next to. He called my house the Lord of the Fly.
Anyway, a really sweet. I love they're great people, but the kids wanted a dog. They finally got a dog, puppy. They had to give it back.
No.
Yes, they couldn't. It was too much.
That was the straw that broke the camel's back.
I guess. Valerie told me they can't keep the dog. I'm like, wow, that must have been some puppy.
They gave the dog. They take like five kids. Sorry, kids, we're taking the dog back. Holy smokes!
And the one kid, she's, I don't know, 7th grade or 8th grade. She really loves to. She comes over and helps our dog every once in a while, and she gives her the.
That's nice.
Hey, before we go to the next call, I want to let everyone know about our March webinar that we've got. This webinar is advanced tax strategies for people with $2 million or more in their savings and portfolios. And this is one of our partner advisors, Lori Ingerson. She's in our Boston suburb area. Been a phenomenal advisor for years, and she's great. Anyway, so she's going to be doing this webinar, and the webinar is about 30 minutes. And some of the things you're going to learn is she's going to talk about the most common places that tax drag hides, and why it often goes unnoticed at higher levels of wealth. So, kind of some of the things we were talking about earlier today. How even good tax move can compound in a meaningful long-term cost when made in isolation.
Yes. Like, well, you think,
here's your focus, Roth conversion or whatever the thing is.
Which is oftentimes you hear people say always and never. And there's no such thing as always and never for a good tax strategy.
Yeah, and why coordination across investments, tax, estate, and income planning is really essential to generate some sort of tax alpha over time. Alpha is having a little excess there. And it's not like a checklist webinar, but it's more of a framework of discussion for those who already know some of the basics and want to think about the next several moves ahead. So this webinar is March 11th, March 14th, March 19th, and March 21st. Again, advanced tax strategies for $2 million plus portfolios. And to sign up, go to allworthfinancial.com/workshops.
And Lori's excellent.
Yeah, she is. Yeah, she's
really
very enjoyable. Let's start here. Let's go next to Pat. Pat, you're with Allworth Money Matters.
Pat.
Hello. Yeah, sorry, the beep happened just as you said my name, and
well, that's because we've been rambling on. You've been waiting, and we've been rambling. So I don't blame you. I would have been asleep by now, but
that's good. What can we do to help?
Well, this is exciting. Listen to you guys. I identified with the fellow who just talked about working from home. I've been working from home since COVID, and I do miss the office kind of thing. So a little
the
bit
office really hasn't got back on. I don't think any company.
Not 100%.
So I got to tell you though. So I'm in IT. So I've been working in cubicles my entire 50-year almost IT career, and so I have the nicest office I've ever had in my entire life right now.
But there's a great balance there between office and work from home. I mean, if you can pull it off, right?
Yeah.
No one wants 100%. Shouldn't say no one. Most people don't want 100% of both.
They like the flexibility of their time.
Yes.
Yeah. It's nice not having to commute to Sacramento. I live up in Rockland in the area, the greater Sacramento area where you guys are at.
Yep.
Anyway, I've called in before. I've been listening to you guys since the 90s.
Nice.
So I really appreciate you guys a lot. But all of that frivolity, let's move on, I suppose. So I'm 70, almost 71. I'm still working a couple more years. I do contracting work for the state of California, so I'm part-time on a Medicaid project. But I've got 3.6 million in IRAs. Of only about 40K of that is in a Roth. The rest of it's traditional IRAs, all been rolled in through various 401ks and that sort of thing over the years. SEP IRA as well. I own my own small business now, sole proprietor.
And are you still funneling money into that, SEP?
No, I stopped this year because, and I think the last time I talked to you guys, I told you I wound up having a situation where we wound up buying another house to help one of our kids who was finding difficulty even renting in this area. And so I took some money, started taking some money out to buy that house, and that
good.
That stopped my contributions because no point in contributing while you're taking out, right? So
okay.
But it's kind of an early, it's like, okay, we got 20 more years, God willing, and then you'll inherit plenty of money to buy a house, but they actually need a house today.
Yeah, that's right. That's right. Well, there's a study I saw the other day that in California, the percentage
18%.
That of home transfers are inheritances now.
Yeah,
because people can't afford to buy them.
I saw that same study, Scott, but I was questioning whether the people actually sold the homes, lived in the homes. It didn't tell us that.
Whatever.
Yeah.
But it's anyway, it's almost impossible for you in person.
That's right. And I assume you're a retired annuitant.
No, I'm actually a consultant. I was 22 years active Air Force.
Okay.
Retired, and then went to work for a big company that got bought by a bigger company when I retired here in Sacramento. I leveraged my IT education and 3 degrees in software engineering in the Air Force into a into a great job. And I worked for a smaller local boutique consulting firm, and then I just decided to stop paying them to cash the checks and went out on my own.
So you're receiving a pension though.
From the Air Force.
I am getting an Air Force pension, and I'm also obviously 70 years old. I started Social Security this year.
How much is the Air Force pension?
It's so I had 2 careers. I was enlisted for 10 years and an officer for 12, so it didn't get up there very high. So I got about $50K a year in gross in the Air Force pension, and about 85 or so Social Security. My wife and I.
The pension. Will that cease upon your death?
Yeah, we decided to go with the insurance option rather than survivor benefit, and then just health-wise, we did the math on my life expectancy, and it's a little bit different than normal. But anyway, so I think we've done okay. So she's taken care of. If I get hit by a car tomorrow, she'll be fine.
So we understand the kind of the scope of it. What's your question for us?
Yeah, so I've been wrestling with like allocations, and one of the things that I've never really been invested, except for one brief mistake back in the COVID era, on bonds, and so I'm about in that 3.6 million. I'm about 15% in money market. I'm about 5% in international, and the rest of it's in U.S. U.S. equities. And so that's 80% or so. I'm taking about a 4% distribution to buy this house, and then that'll continue once I stop working to supplement our retirement income. We're not that thrifty, and we have 9 grandkids, so we have a lot of giving going on, just through the years. So the question, though, is I don't have really anything in bonds, and I have the cash sort of to cover 3 years of withdrawals, so that if we have a downturn, I don't have to go sell something at a loss. But eventually you got to sell, right? I mean, if you're going to take distributions, eventually you got to sell something.
Yeah.
And then you also have, well, what if it goes longer than that? What if we go back to interest rates are at 0 again? So my thought was that, should I have part of my sort of my liquid position in bonds, so that I lock in a little bit higher interest rate than I can get, in the high interest money market, or kind of the other side of it is, should I take part of that 80% that's currently in equities and put some of that in bonds for the purpose of sort of cushioning, a downturn. So I have been listening, and I'm, trying to be educated and things like that. But still, it's like, okay, but I've done pretty well
so, Pat,
in the equity investments.
Pat, do you have any money outside of the 401k?
No.
Zero.
It's all in the houses. I got two extra houses for kids that I'm helping them. So our outside money is our regular cash flow.
I would allocate a little bit more money to.
I think you're pretty high on equities. If you weren't touching these dollars, then it's fine. But the reality is, and I'm assuming, it sounds like you're going to quit working at some point in time coming up, or is that not?
Well, in theory.
Yeah. Okay.
My wife told me I have to figure out what I'm going to do before she'll let me retire.
Yeah.
She doesn't want me sitting around the house
I understand.
watching soaps.
I'd push that allocation to 30 or 35% bond.
Cash and bonds.
Cash and bonds, yes, correct.
I would agree with that. Because you want more than 3 years of expenses, which I think you have anyway, but considering you've got 15% money markets, it sounds like more than 3%. That's, but because if you're
taking a 4% distribution,
so that's about actually probably about 5 years.
There, I would, but I'd move it to 30%.
I would too. And I'd probably have a little more international.
Yeah.
Than 5%.
And even up the international from 5%. Huh?
Oh, yes.
Well, this wouldn't, I mean.
Yeah.
I mean, I just think about the money that we manage at Allworth. We have more than, that's about 6% of the.
Well, just give me a breakdown. I'd put 45% U.S., 15% international, and a little bit more.
But
U.S.
you've got more money than if it was 360,000 instead of 3.6 million. You could have a very simple portfolio. 3.6 million, you've got a little opportunity for some other, like you mentioned, bonds. You're probably not going to want to just stick it in the total bond market index, total bond index.
Yeah, I mean, but it's in an IRA. It's in an IRA, so you've got lots of choices.
Yeah,
you've got lots of choices. I mean, but the answer to your question is yes. Increase the bond exposure some.
And would you do like straight purchase of bonds then, as opposed to buying a fund?
I'd buy a fund.
I had several funds.
Yeah.
Okay.
Who manages your money?
I do. Well, I have it in Fidelity, so I have a.
Let me ask you this:
I have enough to have an advisor but it's not a fiduciary advisor like you guys.
If you died today in a car accident, would your wife be able to manage these dollars? Does she have the same breadth of knowledge?
An advisor.
I got to be really transparent with you. An advisor for you would pay for itself, not cost you. Just based on some of the things that we're looking at. That's our opinion.
So he called for our opinion.
Like I said, I listen. I listen. I've been toying with this for a while. I had an advisor a number of years ago, and I wound up letting him go because I didn't care for the way that he was managing the money. But so I just
not all
myself.
Not all advisors are the same. I mean, obviously,
not all IT consultants are the same.
Yes.
True. Yeah.
All right, Pat. We wish you well.
Appreciate you listening to our show for 30 years.
We agree with you on a good time to reduce that allocation a bit. So glad you called.
So it's really interesting the fact that these what they call stock dispersion, which basically the tech stocks have been getting just beat up. But
some of them, it's software.
Yeah, correct. Because of this vibe coding. But it's being displaced, right? So you're not seeing the indexes fall because other stocks that have been out of favor are doing so well.
Yeah, because there's stocks and
you look at
some big name
like
stocks.
Salesforce and Oracle and Microsoft and Microsoft just
down quite a bit, but the overall indexes look just fine, which means these other stocks have been performing well.
Yes, which
during
is
that time.
Just the case for diversification.
Well, diversification is Well, let's talk about this dispersion a little more. And it's an interesting time because I think investors are a little schizophrenic when it comes to AI. Is it going to be this big productivity boost that's going to help companies be more profitable and make everyone's lives easier, which should be a good thing? Or is it going to be this big job displacement thing? But it's not going to.
Or both.
I think investors don't know how to price. They don't know what the future is going to be.
Yes, but it's interesting. So they're flocking to companies that actually can protect against.
Well, look,
I mean,
the people that build in data centers and stuff, that's way up. But if the doomsday happens, then we're not going to need the data centers in the future.
Oh, because and the data centers it seems to be relatively circular in terms of who's investing in what.
Correct. And what happens when we have chips that need 10% of the power, not
or 3% or 1%.
So it's just a strange time. But to your point on diversification, look, diversification is not a strategy to get rich. It's a strategy to keep what you have. It's a strategy to protect your portfolio and protect your lifestyle. So if you ended up working for a company that the stock did phenomenally well over the years, great. And maybe during your career, it made sense for you to keep a good portion in that particular stock. But if you're getting later in life, do you really want to bet the future on
Intel,
which the stock got, I don't know, down 80% or something,
and
where it was 25 years ago?
The reason I bring that up is because being a financial advisor relatively close to a large Intel plant in the Sacramento area, I remember 20 years ago, people would say, why would I ever sell Intel? Like, why would I ever? Right? And you're like, because you don't want to be poor.
Diversification is a way to protect your wealth.
Yes, it's not going to get you rich.
Yeah. Anyway, it's been great having Evan with us. You've been listening to Scott Hansen and Pat McClain, and glad you guys were with us. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.